Welcome to Know More, Risk Better, a CreditSights podcast. Across the global strategy team, we aim to make sense of the macro and the micro, highlighting opportunities and the risks facing the fixed income markets.
As the macro makes headlines, we leverage our network of experts across Fitch Solutions to better understand economic trends, rates gyrations, geopolitical events, and how these factors impact corporates.
At CreditSights, we understand that credit investing comes down to picking winners to generate alpha and avoiding losers. Our team of over 100 analysts across the US, Europe, and Asia provide unmatched sector expertise and fundamental knowledge.
In our weekly podcast, the strategy team offers a look at the conversations we have with our colleagues, including analysts, fellow strategists, economists, and leveraged finance market experts. If you want to know more so that you can risk better, you'll want to give this podcast a listen.
Hello, and thank you for tuning in to another episode of Know More, Risk Better, a CreditSights podcast. I'm your host, Zach Griffiths, head of U.S. investment grade and macro strategy. And today I'm delighted to be joined by Chiedza Madzima, the head of operational risk at our sister company, BMI. Chiedza, thank you so much for coming on the podcast today.
Great. Thank you for the invitation.
All right, so before we dig into all of the key issues at hand, of which there are many, can you just take us through your primary responsibilities as the head of operational risk at BMI?
Absolutely. So I head up the global operational risk team at BMI, and our work is really about helping clients understand how easy or how difficult it is to operate a business across 200 markets globally. So we cover areas that span labor, security, trade, as well as logistics. And I've been covering operational risk for just over 10 years now. But of course, lately, my own focus areas really have been at that intersection of trade, logistics, supply chain risk. And of course, on the trade and logistics front, we spend a lot of time looking at how goods move, where the bottlenecks are, and how resilient some of these trade corridors really are, as well as sort of more forward-looking take in terms of how they'll evolve in the years to come and how geopolitical or regulatory changes can really filter through global value chains. So yeah, on balance, our work is designed to help clients think through or think about both the current operating conditions and some of the emerging shifts that we're seeing play out.
Okay, so frankly, I can't imagine a more valuable perspective to have on the podcast at this point. If you think about trade, going back to everything with the Liberation Day tariffs a little over a year ago and all of the ructions since then, and of course the Iran war from the shipping and logistical perspective, that has been top of mind. Even today, we're getting headlines now that Iran is closing off communication with the U.S., I believe. And so we're recording this on June 1st. It's 10:39 a.m. I feel like we almost need to timestamp this down to the minute in terms of how things are developing on the war front. If we go back to when this all started, I believe President Trump indicated maybe 4 to 6 weeks was the plan. And from my perspective, Chiedza, if you describe what's happening right now, how long this has already gone on, and how uncertain things seem to be, this kind of feels like what people would have thought of as the worst case scenario in those opening hours and days of the conflict from a operational and logistical perspective. Would you agree with that assessment? Give us your sense of the situation now relative to expectations around 3 months ago.
Well, currently, of course, traffic through the Strait of Hormuz has cratered much more sharply and for much longer than many expected at the beginning. But I would stop short of calling it the absolute worst case, because even in this sort of brittle back and forth, this brittle ceasefire sort of situation, this has lasted longer than we initially expected, or than we expected somewhere in the middle of the hot part of the conflict. And the true worst case from a logistics perspective would have been a prolonged hot war or sharp re-escalation with quite heavy infrastructure destruction, especially across the Gulf export systems. Would have seen repeated attacks on ports and tankers, not only within the Persian Gulf itself, but also compromising freight flows through the Red Sea. And we would have seen a much broader regional maritime spillover. So, that would have meant not just a sort of deep restriction on flows through the region, but a much more durable breakdown in the Gulf's export architecture, and by extension, a breakdown in global access to some of these key commodities that flow out of the region. But of course, where we are now is still a very serious inflection point. And as you mentioned, we're in the third month of these hostilities. The diplomatic back and forth is looking like it's going to stretch well into the month of June. And even after preliminary agreement or sort of solid deal is reached, there's still more discussion areas for the US and Iran to iron out. And in the middle of this, the risk of miscalculation is still very top of mind for shippers. Most are avoiding movement through the straits altogether, and the few that are actually moving through the strait, and generally we're looking at about 10 vessels or less each day, the overwhelming majority of them are following the Iranian route, that northern route. And of course, the other issue is that there are very limited alternatives to the strait. So looking ahead, even if we get to a near-term de-escalation, it doesn't mean that shipping snaps back automatically, right? At this point, we're looking at months rather than weeks for meaningful recovery in Hormuz shipping. And there's a big lag, therefore, sort of between political declaration that the strait is open and a functional market normalization, because you have to consider that insurers, your charterers, your ship owners, port operators, and crews all adjust a lot more slowly than the headlines do. And even then, we're looking at a new normal of lower for longer transits, right? So our modeling actually shows by the end of the year, in the best case scenario, if a deal is reached this month, we'll only get to about 60% of the pre-conflict daily transit levels by December. So,
Wow.
Even this sort of partial restriction phase, or rather the very fact that there's a credible threat of one, is enough to kind of weigh on confidence to that effect.
All right. So you say 10 ships per day now, and maybe getting back to 60% of the pre-war transit. What is the pre-war transit, just to frame that up for our listeners that might not be as familiar?
Of course, many figures have kind of been thrown around in the media. I think 100 is that kind of baseline mark that everybody looks at, but actually, pre-war we're looking at around 138 daily transits through the Strait of Hormuz. Right
Wow.
now, we're sitting at less than 10 daily transits. In fact, there was a point when, if you recall, Trump had declared the strait open. The Iranian side had also said the strait is open for this very brief period. And the most ships that we saw during that time was about 35. This includes those that sort of turned off their tracking or their AIS tracking during that period. So it's not, these are very suppressed transit figures, transit volumes that we're seeing, where even at the peak, we're still well under 30% over the duration of these past 3 months.
I think that's really helpful perspective. And as you frame that up, especially considering best case scenario is 60% of pre-war transit, I am shocked that even today, with the latest bad news, oil, Brent, remains below $100 per barrel in terms of spot prices. And I think, you make a great point. Worst case scenario would certainly be that there is persistent damage being done to infrastructure and a true hot war, no tentative ceasefire, whatever we're calling the situation right now. And I think that's a great point, although I don't think that many people had considered that a super realistic scenario at the outset. Nonetheless, it seems to me oil prices, given the situation that we've had now and the situation that we're facing going forward, have been incredibly resilient relative to what I had heard from oil analysts, and one to kind of consider the oversupply backdrop that it seemed like we were going to have coming into this year prior to the war. Are you surprised by how well oil markets in particular have held up given the level of disruption that we've had so far?
I'd say yes, mainly because in operational risk, we look at disruption through a physical flow lens. But of course, when you widen the frame to include policy responses that we've seen around the world, like subsidies, rationing, sort of price controls, the availability of inventories, some substitution that's happened, and of course, expectations of reopening, the market reaction becomes a little bit more understandable. And there are three key areas at play here, if you allow me to expand. So first, markets are not pricing in today's disruption in isolation. They're pricing in an expected recovery path. That's really the thick layer that we're seeing in the pricing trends. And a lot of the resilience in oil has come from the view that it's still a constrained shock rather than a sort of permanent loss of Gulf supply. So right now, markets see the conflict as closer to the end than the beginning, and they expect flows to resume very quickly. We don't agree with the latter about the quick resumption part. And of course, I guess overall that belief has kind of kept the back end of the futures curve relatively subdued. I think the second factor is that they've been offset. Producers, consumers, they've been leaning on inventory, strategic reserves, and sort of flows coming out of the Atlantic basin, just giving that rebalancing or that extra cushion for the immediate shock. But of course, these are not free, these are not costless offsets, but they do reduce the immediate supply shortfall. We'll see what that looks like circa June, July, when these drawdowns now, or the cumulative effect of these drawdowns now really start to kind of trickle through. And look, we're already seeing risk of physical shortages appear in some markets, especially in emerging Asia. That's quite at risk. At the same time, the demand side matters. Markets also weighing the drag from higher energy costs on global growth, and that macro headwind can also kind of cap how far prices rise. The third issue is that there's an important sort of distinction between price resilience and operational normality, rather. And the fact that Brent is below $100 doesn't mean the logistics side is healthy. And I think that's the section that's a little bit less understood in the market, right? You can have a market that's partially buffered by sort of inventories and expectation, but the physical system is under significant strain. So in reality, I think the operational side of the oil complex still looks far from normal. And we're starting to see some market leaders, especially in the sort of oil and gas space, start to kind of ring the alarm bells on this particular issue. We're already seeing storage bottlenecks. They're emerging across the regional producers within the Gulf. A lot of the upstream shut-ins are being used to manage this constrained export capacity. And even then you even have to factor in at least 2 to 3 months for tankers, for terminals, for crews and insurers to really realign to start to get those flows going, even after we see a durable de-escalation. I'd stress that the oil market has not fully ignored the risk, but there isn't a full appreciation of some of the more operational aspects of the risk. So it's just been quite selective in how it's pricing this risk. And even under a deal scenario, I do wonder if geopolitical risk premium will disappear quickly, right? The shape and the durability of any truce is still uncertain. And if this episode leaves the market believing that Tehran will retain coercive control over transit through the Strait of Hormuz, then that there's going to be some residual premium that could remain baked into both oil and gas prices and shipping rates as well beyond the crisis. So we understand why prices have not moved even more violently, but we do think there's a big gap in how orderly the market can look on screen and how impaired the underlying logistics reality really is.
Well, I think that's hugely important, and I want to get your perspective on, is there a moment where the rubber meets the road in terms of these operational challenges and lack of health and some of the more physical considerations where that will hit the financial markets? Is there a situation where it becomes undeniable that no matter how much optimism you want to price into the forward curve, the here and now is too challenging to ignore? I feel like that's a difficult question to answer, but that's kind of where my head is in terms of this disconnect. Is it one that can persist indefinitely, or is there going to be a moment where perhaps the market breaks to some extent? And I think that that would have broader implications for financial markets and maybe the global economy, certainly. How do you think about that? Yeah.
Yeah, I think certainly that moment will be when the shortages become a bit more pervasive globally. Right now, the concentration of risk is very much already being felt in a lot of emerging markets in Asia, in Africa. Think of, the likes of Ethiopia, fuel shortages, same with the kind of interventions that we're seeing out of a lot of states in Asia, the likes of Thailand, Pakistan, be it price freezing, rationing. But I wouldn't isolate it to just those markets. I'd say it's a much broader East and Southeast Asia challenge. The timeline that's being floated around quite a lot, and I'm sure you've seen this if you are watching Bloomberg very closely, is sort of end of June going into July is likely that point where the rubber meets the road, where we start to reach that operational stress level within the global oil complex. So that's really the stopwatch, I would say, or the timer that the negotiators have to keep a laser focus on, both on Iran's side as well as from the US perspective, when we will start to see that operational effect or those physical challenges start to create it through sort of paper markets as well.
Okay, well, I'll certainly mark that down on my calendar in terms of kind of the end of this month into early July. We're going to be trying to put out a second half of 2026, first half of 2027 outlook around then. So that could be a particularly large variable to sort of factor in there. And I'd like to know what your clients have been asking you about most, and maybe even just some perspective on who some of your biggest clients are. I was shocked, even in the initial days of the Iran war, during the client meetings that I was doing, either over video or in person, for fixed income investors, they were more concerned about BDCs and private credit, and kind of have been almost throughout this time frame, which has been a little shocking to me. But when you look at the resilience in the equity markets, if you look at how tight credit spreads have remained, maybe it's a little bit less surprising in retrospect. Anyways, I want to know what your clients are asking you about and sort of how that frames up your perception of continued risk in the sector, or maybe things that you think clients aren't focused as much on that as they should be.
The majority of our clients are very much in the sort of banking and financial services spaces, but we also have quite a wide range of clients in shipping, that are in logistics, that are in industrial production, right? Like your large chemicals producers, those in the sort of agri space as well. And I'd say that mostly the client questions for our team have been very practical and quite operational. Everybody has access to the tickers, the news flow, the headlines, but they really want to know what's happening on the ground. What does this mean in terms of duration risk? How bad is the conflict? What does this mean for different industrial inputs and the sort of broader supply chain network? And which regions are most at risk? A lot of our clients are multinationals or have a very sort of cross-market footprint. So all of those aspects are quite important to them. So one of the most common questions has been around recovery timelines, especially for those in sort of banking, financial services spaces. They're concerned about how quickly normal shipping can resume if peace broke out, and what kind of permutations of that deal or a peace agreement, what would those look like? And of course, we're able to explore how factors like global vessel repositioning also influence this, with so many tankers going to the Atlantic basin. How long then will it take them to get all the way back to Asia, or even to then reposition to kind of re-enter the Strait of Hormuz? There's the issue of congestion, your backlogs, underwriting as well, and how that will likely play out. And a second big theme has been areas like compliance and control risk, sanctions, right? So for many shippers, your logistics operators, the issue is not just whether a route exists physically, it's also whether it remains usable within an acceptable sort of legal, insurance, and financing framework. And of course, that's a very different question, and it matters enormously for actual routing decisions, trade finance decisions. And I suppose if you combine these two, the real question becomes, when do supply chains regain that level of predictability? There's a third cluster of questions that has come from a lot of firms that have high input exposure, especially in your chemicals, industrial processing. They're less focused on the sort of headline crude prices and much more focused on the sort of second order effects on petrochemicals, your fertilizer inputs, helium, sulfur related processing constraints, those kind of areas, and what the knock-on effects will be for their manufacturing value chains. So this is why internally we describe the crisis not just as a conventional oil shock, but a sort of broader input shock, right? The supply chain damage from this conflict is flowing through several channels, and each of them with a different time signature. So energy prices are just the loudest and fastest moving signals, but you have fertilizer, your specialty chemicals, other sort of petchem derivatives, industrial metals. These are also repricing in the background, even though it is more slowly than oil moves. And of course, then later you'll start to see the downstream industrial effects, and some of these goods can really take months to re-anchor. So the fact is, or the takeaway for those clients is that, the disruptions don't stay neatly inside the energy complex. They really propagate more outward through multiple production systems. And of course, some of the medium to long-term, broader conversations with clients around the path to a permanent shift towards buffers, more regional diversification, more careful partner selection. And basically the debate is moving from simple rerouting towards sort of system design, especially in a world where this issue of choke point risk is no longer a tail event. It's the baseline, right? Industrial firms are thinking a lot more about how to operate inside a more resilience-based, a more insurable logistics framework where, sort of flexibility, your counterparties, and concentration risks really matter a lot more than they did before. And we expect this to perpetuate over the medium to long term.
Well, that's exactly where I wanted to go next. I know you've put out a piece looking at other maritime choke points globally, and I do want to hit on that. But before we go there, I've been considering, as we think about this and think about what the global shipping landscape looks like going forward, how much is insurance almost the core of the issue? Now, I understand Iran obviously can impose some controls and to try to have the U.S. Navy try to police the entire shoreline. That's effectively impossible. I think I saw that would be like trying to patrol the entire east coast of the United States. But taking that together, how much does it come down to the lack of insurance provision, and how much do you expect that to be a persistent issue, even with some sort of arrangement to the end of the war going forward?
Yeah, that's a great question. I think the lack of insurance provision was a big issue at the very start of the conflict. Very much so over the course of the first month of the conflict, where a lot of insurers pulled out, a lot of P&I, or protection and indemnity clubs, could not provide kind of cover that the ships needed. But I think what we're seeing now is that, yes, insurance is a major part of the story, but it is available. It's just not available at economically viable levels, as it were, right? We're about 5 times up from where it was prior to the conflict. And bear in mind, insurers were well aware that there is an elevated amount of risk attached to the Persian Gulf, especially in the wake of some of the conflict that we saw in the middle of last year, again, between the US and Iran. But that was short-lived. So there was a little bit of that baked in, but now it's very much at less than economical levels for shippers. So that's a little bit of a deterrent. I say that because, yes, insurance is a big part of the story, but it's not the only driver. It still sits along with the broader issues like security risk itself. I mean, shippers are very risk averse, and especially depending on the cargo class, LNG shippers have been some of the most risk averse, given the value of the cargo, the value of the vessel, and the kind of specialty crew you need on board. And these are some areas that war risk insurance doesn't necessarily cover, in addition to loss of future revenue. That's the big concern. The other areas that sit alongside insurance are, again, regulations regarding the level of control that Iran wants to exert over the region, the kind of charges that they're looking at, and the pressure that we're seeing from US authorities in turn when it comes to sanctions surrounding the very bodies that Iran wants to put in charge of regulating that waterway. You have crewing constraints as well, just trying to get charterers and crew that are willing to traverse this very dangerous areas, and some compliance concerns, as well as other broader geopolitical dynamics within the region itself. So yes, there is insurance, but there are other major barriers and considerations that are stopping shippers from really returning to the region at present, or would constrict what that new normal of vessel flows will look like moving forward.
And so thinking about the knock-on effects of all of this, even just how long this has persisted, I think one of the more concerning situations that could come out of this is Iran effectively shows that they have control. And while we could probably dress it up as a victory in some respects for the US, if things were to end today the way they are, it feels in a lot of ways like a victory for Iran and its kind of grip on global supply chains. Setting that aside and kind of getting into the other maritime choke points, where do you have the biggest concerns of longer term knock-on effects, even just assuming we get a deal today and things don't dramatically worsen from here?
Yeah, I think the more important long-term effect is how this episode really reshapes perceptions about concentration of trade, concentration of risk, not only within the Strait of Hormuz, it could be the Red Sea, but I think across all the maritime choke points. The issue is that if competitiveness depends on, for instance, where goods are produced, choke points really determine whether they can move at all. And the focus area, I think, moving forward will be on building both the necessary physical infrastructure as well as institutional infrastructure to manage that risk. And this is going to be quite a capital intensive endeavor for governments, for companies, not only within the logistics space, but especially those with a global or cross-national footprint. And I think the key lesson from Hormuz really reinforces the wider point that global trade is still too concentrated across a small number of critical passages with limited redundancy. And we're already starting to see some efforts to build in that redundancy with some of the plans that the other Gulf states are laying out in terms of building more fallback sort of pipelines. We're already seeing increasing efforts again to kind of build out overland routes as well, not only within the Middle East. So you can consider the Eurasian Rail corridor, Eurasian rail networks, and just to look at alternative secondary choke points and increasing the shoreside capacity thereof. So this situation definitely has implications beyond the Gulf, beyond what we've seen in the Black Sea as well. That's also very much in consideration. I think the medium-term center of gravity for disruption risk moving forward also still points to East and Southeast Asia. If we just consider the Strait of Malacca, which is especially important because it carries such a large share of Asia's energy, it carries such a large share of the world's manufactured goods trade. Or you can consider the Panama Canal, which shows a different type of vulnerability profile altogether. This issue of climate-driven water stress. I mean, this year we're looking at a super El Nino that's on the cards, the kind of capacity restrictions that would then stem thereof, the erosion of reliability. And this is quite different to a kinetic security crisis as we're seeing in other regions. And when it comes to Panama, they also US-China tensions surrounding control and influence of the surrounding port infrastructure there. So certainly from a supply chain perspective, the most important structural effect is that firms and countries are going to pay more money and pay more attention to input concentration as well as route concentration together. So this is where I think those long-term implications also become more important. On the input concentration part, we're likely to see more emphasis on diversified energy systems. And this kind of brings momentum or breathes new life into alternative energy buildup, renewables, right? More emphasis on industrial policy interventions when it comes to strategic sectors or your security sensitive sectors. We're already seeing this when it comes to areas like semiconductors and, of course, more inventory buffers. So, yeah, the bigger legacy here is one of precedent. The Hormuz disruption, it's just the latest signal. But this is following the impact of COVID, it's following the Russia-Ukraine war. It's just the latest deep signal that resilience, just efficiency will really start to define system design going forward.
Yeah, that's really interesting to consider. If you even think about some of the actions of the current administration on trade policy and now with the war and considering how that probably contributes to a turn inward in terms of many years of globalization and a lot of that reversing. Obviously, you can only turn so far inward in terms of what natural resources are available to what countries and how those countries are aligned with their allies, and there's a lot to consider there. It seems like there could be some very substantial long-term implications of some of these policies, and I think your point on renewables is very interesting. We just had a podcast with our utilities analyst, Andy DeVries, speculating that the clean energy tax credits will be coming back as there is a renewed look to alternative energy sources, renewable energy sources, and things like that. So there's really a lot to consider. For me, I see oil prices move every day, and as a macro strategist looking at government bonds being really the most directly impacted after energy prices, and that's kind of in this world of having everything on the screen in front of you at all times. That's kind of been my focal point, but it is interesting to zoom out and think about the longer term knock-on effects and those economic and financial market implications, which probably aren't driving market pricing today, but will be very important in the longer run. The other factor to consider, I think, from a longer run perspective is defense and security. And I know that's part of your remit as well. I think it seems like the big focal point in the press these days is kind of what that means for Taiwan and how China may consider approaching that situation, especially given you still have Russia-Ukraine going on, which has seemingly fully moved to the back of people's minds, the back of the narrative, and now the Iran war. What are some of your biggest concerns or focal points from that defense and security perspective, from considering knock-on effects of what we've seen over the past 3 months, and I guess even zooming out to over the past 4 years or so, including Russia and Ukraine in that consideration?
Yeah, no, that's a good point to raise, the defense perspective. I think a key implication is that maritime security is becoming much more resource intensive and, of course, more persistent as a budget line, not only in light of what we're seeing within the Middle East, but even in the context of the sort of Russia-Ukraine war. We've seen various attacks on Russia's fleet, on sort of shoreside infrastructure as well. In turn, the same has occurred to Ukraine. So that maritime security part, I think, is going to be an area that governments in Europe, the United States, in Asia, and in particular, the likes of China, South Korea, Japan are going to start to focus on a lot more. Governments, in effect, are being reminded that protecting trade, protecting critical supply chains, it's not a one-off crisis response. It's an ongoing and is set to be a much sort of bigger budget, ongoing strategic requirement. I think for Gulf states, this certainly means stronger incentives to invest in naval capacity and port security and surveillance, in the sort of tech that enables that security and surveillance. And of course, as I mentioned earlier, investing in redundancy and sort of export infrastructure. This is going to need closer coordination with security partners like the US and like Europe. For your Western governments, your sort of NATO members, it really reinforces this broader shift towards higher defense spending and more attention to the protection of energy and transport infrastructure, as well as undersea systems, undersea cables at the same time, both which have been threatened not only in the context of Russia-Ukraine, but also in the context of the US-Iran conflict. So the challenge here, of course, is that larger defense outlays also require tough fiscal trade-offs over time. And there's a doctrine issue here too, right? Security planning has to move beyond classic naval escort thinking and kind of account for the hybrid disruption that we're seeing. We have to think about drones, mines, missile threats, cyber risk, transit controls, the compliance layer when you think of insurance disruption, and the kind of pressure on communications infrastructure. So this current situation, I think, also highlights the limits of existing international frameworks when you consider UNCLOS, or the United Nations Convention on Law of the Sea, which kind of provides that legal backbone for freedom of navigation. It's also proven insufficient to prevent disruption in practice, given the kind of security situations that the world is confronted with now. And although the US remains a central maritime security actor, its presence hasn't really fully mitigated transit risk. We already saw this with the situation in the Red Sea, with the attacks on the Houthi rebels. It took over a year for the US and Europe to coordinate security architecture there that worked to open up that critical waterway. So I guess in that sense, maritime security is likely to remain high on the policy agenda, even after this specific crisis eases. Of course, countries will look to spend more. There's a tech layer to it, and we could see a further bifurcation of tech production, tech sharing in the years ahead, with that national security focus in mind. And yeah, countries will just need to think a lot more broadly about resilience in ports, cables, logistics networks, and not just warships at sea, which are increasingly spread thin relative to the scale and the diversity, most importantly, of the emerging threats that we're seeing evolve.
Yeah, I think the fiscal point, again, not to let the bond nerd come out too many times in this call, but that's certainly been priced into markets, it seems, to some extent. In the US, we have had a bit of an upside surprise, I think, on economic activity and earnings contributing to higher yields. But I think there is a bit of a zooming out considering the fiscal implications and the need for spending on security going forward, certainly with President Trump putting forth a budget proposal with, I think, a $1.5 trillion outlay for defense spending in a single year in the U.S. Those are some pretty crazy numbers to consider, and I think it's starting to be priced in to the bond markets to some extent. Chiedza, we covered a lot. I feel like we scratched the surface on some of these topics that we could probably dig into for many hours on each, but I really appreciate you coming on the podcast and sharing your perspective. I think as this situation persists and potentially continues a bit longer, we'd love to have you back on the podcast to hit on a few more things in detail. But this was a great discussion, and really appreciate you coming on Know More, Risk Better.
Zach, thank you very much.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.